Now we get to turn to Asia, and we're going to kick off with China. And this chart may look familiar from segment 1, and it's just looking at the amount of lockdowns in the in China itself. So bottom up analysis. So China's top 100 cities by GDP finds that all but 13 have imposed some form of quarantine restrictions. Again, level 0 being nothing, and then obviously up and up. So we have 5.1% with some full lockdowns, level 3, 6.6%, level 2, 27.1%, level 1, 26.9%. So essentially all except 5% have some sort of lockdown. Now, the reason why we're talking about this right now before we go into the economic data is because what is the collateral damage on that zero COVID policy? And it's getting worse. And one thing that we want to start with is logistics. So logistics and supply chains have been significantly adjusted and hit based on these containment measures. So over the weekend, stories of widespread road closures along China's eastern coast went viral. So according to reporting by logistics companies, access points to interprovincial highways were shut off in at least 10 coastal provinces. So just think about if you want to go from, let's just say, for an example, going from Florida to New York. And if you're shut off in North Carolina, even though the rest of the country is above you and below you are open, you're not passing or you're going all the way around to get there. And at that point, you might as well just sit and wait. Those are issues that continue to happen, and there's some steps that are now being taken. So Monday morning, almost all reporting of the roadblocks on social platform on WeChat had been deleted. I know, shocker. But then what is clearly something's going on. So on Saturday, the Ministry of Transport revealed that it held a meeting Thursday to address the logistic problems. So what did they talk about? The idea is prohibit local governments from setting up COVID-19 testing sites on highways or service stations. Again, keeping that open. Ban local governments from closing service centers along highways so you can get fuel, food, whatever. Establish a nationally recognized COVID-19 travel pass, especially for logistics professionals and truck drivers. And then on the other side, abolish unauthorized travel restrictions. Now, this is the problem with the Chinese solution. You hinder and you beat up governments that have spread, right? So if you're a government that has seen their city, their province explode with COVID, you're going to get penalized. You're going to get in trouble. So you're going to go above and beyond to try to minimize the spread. So you show you're doing everything that you can. Then on the other side, you have the government coming and saying, but you have to let people move through the cities, through the towns, through the province. So you're like, all right, well, on one side, I get in trouble for it spreading. On the other side, I get in trouble if I don't let people through and effectively let it spread. So it's like, okay, well, and this is why when you think communism is so great, it's like, well, so which one do I follow? Do I follow Directive A or Directive B? Because they're in direct conflict with each other. And that's where you see these unknowns, because people would rather shut things off and get tapped on the wrist for by the Ministry of Transport versus letting a COVID spread going. The problem is, I'm assuming this is Omicron. If you look at someone with Omicron, you catch Omicron. So again, there's also a lot of issues in terms of trying to pin it down. So the Vice Premier, Sun Chunlan, has also called out the problem in Shanghai on Saturday. Sun urged local officials to break through transportation and distribution blockades as soon as possible. Local governments trying to prevent another Shanghai-style COVID outbreak in their jurisdiction are behind the widespread road closures because they're so scared of what happens if they experience spread in their own country, in their own region. Road closures and other COVID containment measures have already caused major economic disruptions. The central government is trying to eliminate the problem by containing COVID. Remains the number one priority. This means that some level of disruption will persist. AKA, and all of this adds up to more downside risk to the economy is mounting. So now when we look at PPI and whatnot and CPI, So let's look at foreign reserves, which have fallen. And again, it comes down to them trying to do more, spending more. So foreign reserves have come down to do that. PPI, again, this is what it gets exported. The PPI is at 8.1%. Well, it was expected to be at 8.1%. It came in at 8.3%. CPI was expected at 1.4%, came in at 1.5%. This is a problem. The problem is they continue to buffer the consumer from the PPI. So they have to export as much of that cost as they can to try to recoup some of the loss while protecting the consumer, which is getting harder and harder. So aggregate financing came up. New young loans, again, came above expectations. This was after that very weak March. Again, trying to manage the credit impulses, which again are going to ebb and flow. We'll talk about that in a minute. Money supply grew, but as it has grown, this was for March. They've actually started to shrink this again. Remember, the credit impulses don't just go in straight lines; they kind of go in waves. And so we had some positive, like we had some down moves in February, some up moves early March. Now we're getting some down moves in April, and again, you're going to move that back and forth. Exports were expected to be at 12.4%, came in at 12.9%. But for those that have been watching us for the last several years, imports are a direct correlation to how strong exports are going to be, because you import stuff to export stuff. Imports were expected to be at 6.3%. Instead, they came in at negative 1.7%. Now, there's obviously some piece to this in terms of the lockdowns, but not all of it. And it continues to show, and we'll talk about this coming up, employment is a problem. Spending is a problem. Imports are reflective of what you're going to import to turn around and export and what you're going to import for locals to consume. And all of that is just indicative of more pressure that is coming from the market. Now, when we start looking at annual change in aggregate Chinese stimulus as a percent of Chinese, national gross domestic product versus J.P. Morgan's global manufacturing PMI, you get an idea of the pressure coming down and the movement overall as we get some of these shifts in just credit impulses. So it's also important because the government is trying to promote spending. It's trying to promote some sort of support. So special purpose bonds, SPBs, are back in favor because they went out of favor. Now they're back in favor, and that's what they're trying to use. So at the March National People's Congress, Premier Lee announced a renminbi 3.65 trillion special purpose quota for 2022, unchanged from 2021. So speed up the issuance of SPBs, increase credit support, and streamline project approvals is what they're trying to say, especially for water conservation projects, because water continues to be an issue. Vice Premier of Finance, Hu Hongchao, echoed Lee's message, saying the MOF needed to, on China's internet side, act to guide local governments to issue and use special purpose bonds as soon as possible. But when it comes to SPBs, officials want both quantity and quality. Now, for those that have been in charge of deploying capital, sometimes you can always find some place to put money. Like you can always find an investment, but is it quality? And we saw from 2016 up until recently just how the quality degradation ramped up. So now you're back and you're being told to issue more, but with what quality? I can do it. The quantity is there. There's always people that want to take government money, but is it going to the right place? So Zhu laid out some specific rules in terms of the distribution. Limit issuance in areas of high debt risk, which if you think about the real estate sector was low debt risk up until recently. Focus on funding major projects that have clear social and economic benefits and avoid pepper sprinkling. Don't spread the cash across too many disparate projects. Again, not easy. Now, what are they focusing on? Water conservation, information infrastructure, agriculture modernization, grain storage, and logistics. Noticing a theme on food, right? Water, food. You need water to raise crops, and this continues to be that main view. As headwinds to China's economy mount, Beijing's urgency to get project funding out the door grows. The faster SPBs are issued, the faster projects break ground, and the faster employment opportunities materialize, because they're trying to push the employment, which has been contracting for well before COVID ever came onto the surface. With Beijing pushing to get money out the door fast, some of that money is going to end up funding unproductive projects and will continue to undermine growth in the years to come, which we've already seen. Now, when we start looking at what is happening in Europe and the US, Europe and US account for 36% of China's export economy, Western Europe being the largest. And again, that's, I think, the biggest problem when you look at the relationship between what is happening in China and what is happening in Europe. And that's why when you start looking at issues in Europe, inflation based on the inflation that's going to come from Europe into China, and as they account for 36% of China's export market, well, as they slow, then what? So again, dual circulation strategy, trying to build up the business internally. So the central government policies to ease burdens on struggling businesses have come quickly. Specifically, in terms of the main message, accelerate the implementation of policies that have been set to bail out enterprises, stressing the importance of macro stability, agriculture input prices, employment, business vitality. Remember, there we are again, agriculture, employment. If the price of agriculture materials is still high when the autumn grain is planted this year, the state will take new measures to subsidize agriculture materials. We should stimulate market vitality, promote mass entrepreneurship, and allow new business forms and new models to emerge. The progress of tax rebates should further accelerate so that enterprises can get real money as soon as possible. Lee wants to make sure officials are using all available policy tools to juice economic growth and support businesses. Even with broader stimulus, a 5.5% growth target seems out of reach. Because if you think back, exports were how they were able to make up even a semblance of the slowdown. And now you have a lot of these countries, US, Europe in general, that are struggling. Where are they going to go? How much of that is going to come through in terms of US and Western Europe's share of Chinese exports? And how do you replace that? Well, try to replace it internally. And that's becoming harder and harder. So then when you start looking at, again, where those exports are going, we've talked about multiple times, new export orders are down, new orders are down. All of those are leading indicators that continue to crop up. So now when you look at exports rose, when you look at the trade surplus was $47.3 billion in March, compared with a surplus of $115.95 billion in January, February. The collapse in imports is the real shocker because the consensus forecast was for an 8% year-over-year expansion. Given the lag between Chinese companies placing import orders and the goods arriving, last month's collapse in inbound shipments is more likely to be down to port disruptions rather than weaker demand because of COVID-19 lockdowns. Lower demand for imported goods because of production disruptions will show up in the imports data in coming months, as if you look at things going forward. The slowdown in exports mainly reflect the softening in overseas demand. Since May 2021, the new export order subindex of the MBS manufacturer PMI has been in contractionary level. Again, coming back to what we've been seeing. Export growth is on a downward trend due to last year's high base and the shift in overseas household spending towards services as countries drop COVID-19 restrictions. And again, they kind of cap down. As we talked about in previous segments, you're seeing, again, goods coming down, services coming back up. Going forward, export shipments will also be hit by production stoppages, and that's, again, going to continue. And import growth will have been well into negative territory in March in real terms. Adjusting for high inflation, China's trade picture in March was even worse when you consider, that real terms. Lockdown-related production stoppages will be temporary, but with both the global and domestic economy weakening, the extent to which import and exports will recover once this disruption ends is unclear. Which is why when you start looking at Chinese CPI, again, creeping back up, and then when you look at core CPI, which is the one that they've been trying to target, it still remains sticky with the inability to get this back down. And now you get all these supply disruptions, all of these shortages. It's only going to continue to make things worse. So then when we start looking at Chinese PPI, you get an idea that it's just, again, flatline. You had the spike and now, but things are going to continue to get worse and struggle based on the problems that we're seeing, based on the issues that we've seen in terms of trade because of the logistics. Road traffic between Shanghai, Jiangsu, and Xinjiang, most of the Yangtze River Delta economic belt, has dropped to a crawl so far in April, again, leading to the problems that we've continued to see. Industrial supplies are bearing the brunt of the local roadblocks, while priority is given to daily essentials. Again, all leading to these PPI pressures. Trucks carrying food and medical supplies get first dibs. Epidemic controls have also created a shortage of drivers. Local lockdowns are causing chaos for businesses, and recent orders from the central government to clear blockages. ASP won't provide relief soon. Logistics will only start to normalize when the Shanghai lockdown is fully lifted. So again, that's all going to show up in PPI because you're going to see these costs get passed through. Then when you start looking at China's foreign exchange reserves continuing to dip, you can see that they're now at the lowest that they've been since the beginning of 21, end of 2020. And the reason why is when you start looking at what they're doing, they're trying to protect. They're trying to create some sort of again, protect against inflation, increase jobs. So the April meeting, which economic policy was discussed, Lee issued a laundry list of measures to stabilize employment and prices. Supporting measures, improve employment. So what about prices? Ensure the supply of agriculture products, food, support more coal-fired power production to guarantee energy, and support logistic companies in order to try to do these things, but they're not free. You still have to spend money to do this. And given the fact that they keep giving tax rebates, they keep doing all these things, now they're starting, and one of the things that we keep showing is that their foreign reserves are going to continue to kind of drip lower, especially as trade falls. So Premier Lee unveiled a similar set of macro measures at Wednesday's State Council executive meeting. In particular, he said agencies should investigate how they can support folks who are facing difficulties repaying loans due to the pandemic. All of this continues to be an ongoing theme, making that 5.5% that much harder to obtain. Now let's layer on developers. Year-on-year change in sales of China's top 100 developers. Builder asked, Zenharo asked holders of about $1 billion of bonds set to mature this year for more time to repay. It didn't pay a combined $20.4 million of interest on $2 bonds, which has resulted in the event of default. So also said, then Zenharo also said it might not be able to pay a combined $32.6 million of interest due on 3 other dollar bonds before grace periods end between April 10th and May 14th. Failure to meet the obligations would also constitute events of default. The firm said it intends to pay the due interest on all 5 notes by May 31st. So again, the question is going to be, do they get that kind of partial default? Missed payments are a reminder of the fragility of the Chinese property sector, which again continues to show. All the while, Caxton Services PMI coming negative, MBS Service PMI negative, retail sales also, as we've been talking about, coming down and will be negative. So they continue to get, Beijing continues to worry about unemployment, which has continued to be a theme throughout. Vice Premier Hu he held a symposium on jobs, calling for all-out efforts to stabilize. Again, they're trying everything. The top leadership uses events like this to gather input and issue statements. Relevant departments should solve the difficulties faced by enterprises in a timely manner. Employment agencies should continuously improve the quality and level of employment services. Again, all of these things, they keep saying they're going to do them, but it's very difficult to actually go out and do it when you have lockdowns, when you have micro, small, and medium businesses unable to function, again, creating these underlying problems. So then China corporate and household credit impulses has not bottomed yet. So here's where you look at excluding local government bonds. You can see that big drop where including local government bonds, remember special purpose bonds, that's where you get these waves. But excluding local governments, banks are still not lending. People are still tightening up. And that's why we do think we're going to get to the level that we saw in 2015. Total inland transport investment in China compared to others. again, they're dumping money back in, but how much of it is going to the right place at the right time? Which again also leads to how much stimulus can they put through given where credit impulses are, which is why we look at China's RRR and industrial output. So they've only been easing all the way through since 2017. The last meeting, the league put together other measures, suspending mandatory Social Security payments for enterprises in catering, retail, tourism, civil aviation, expand unemployment insurance, increase financial support. Again, everything they can to try to keep money moving through. Also reserve some space for less targeted macro, encourage financial institutions to lend to the real economy, back to, again, taking away government's subsidies that we saw, which is why things have been so negative. And again, agriculture, small business continue to be the main piece. Fee cuts, unemployment assistance all remain kind of the key threshold. China monthly new loans, you get an idea of where they are, but cumulative, again, continue to be right in line, right where they need to be, based on the SPB component. But then when you look at the aggregate in terms of where they are, still below 2020, still above on an actual level. So still moving in the direction as they continue to push companies and local regions to do this. China's service sector at its worst since early 2020, as the Caxton PMI shows. Again, all of this going firmly negative, and we have more negative readings to come in the month of April. Then when you look at cheaper peer lending, China interbank loans have cost less than central banks' policy loans for months, but yet they're still not borrowing, as we showed with the Chinese credit impulse. Liquidity in China's banking system appears to be stable. At the moment, the rates on one-year negotiable certificates of deposit and interbank borrowing instrument are below the cost of the MLF, but yet nobody is still borrowing because, again, there's still so much fear in the system. Now, shifting to India, the reverse repo rates, everything was held constant. Industrial production was expected at 2.7%, came in at 1.7%. CPI expected at 6.4%, came in at 6.95%. Again, we are on our way above 7%. Exports came in at 19.8, imports at 24.2. Again, things still remain fairly stable when we're looking at the trade front, but industrial production is showing that slippage as well as the pressure on CPI. So India estimate, because of this, in the second half of March, the RBI spent close to $4 billion per week slowing the rupee slide. There are tons of reserves to do that if they want to, but with oil at 100 and a current account deficit headed to over 3% of GDP, the rupee is overvalued at current levels, and they're trying to protect it, but there's only so much that you can do before you finally kind of get that crack, and then there's really nothing else that can be done to protect it. Which is why we do expect the reverse bank, the India repurchase rate to increase. When you look at 4%, we do expect that to come to at least 4.25, if not 4.5%, given where some of these pressure resides and the increase in inflation. CPI inflation coming in at that 6.95%, coming towards the highs that we saw in 19 and 20, and well above the target of 6%, which is why we do expect to see those increases, because CPI year over year, you get an idea of where we are, but on bread, new all-time highs going back to 2015, 8.4%. On all of these key pieces, food and beverage, when you look at vegetable oils, when you look at fats and oils, 18.8%, 11.6%. All of this is accelerating. So CPI inflation at that 6.95%, 7% is all drifting back up when you start looking at what the impacts are from the lack of Ukrainian and Russian imports of vegetable oils. Core inflation jumps higher. March was at 6%. RBI measure of core CPI inflation 6.5%. Housing 3.4%. Clothing 9.4%. Fuel and lighting, something that again we think is going to drift higher. Medical care. All of these key pieces are all moving in the wrong direction, as you get service business activity in India kind of flatlining. But when you look at industrial production starting to dip, now below where it was in 2020, it normally dips in February. The question will be, what does the rally in March look like, and does it underwhelm? And that's going to be kind of a bellwether and a setup for what do we expect into some of the spring months. Japan leading index coming in right in line, nothing too crazy there. But when you look at the economic surveys, consumer confidence dipped from it was expected at 36.8, came in at 32.8. Economic survey was expected at 45, came in at 47.8. Machine tool orders year over year dipped. They were 31.6 last month. In March, they were 30.2. All the while, PPI is going higher. Where does the U.S. import from? India, China, Germany, Japan, South Korea, all of which have a surging PPI, which we will import, again, keeping our inflation, when you look out, very much elevated. Bank PPI month over month expected at 0.9, came in at 0.8 as money stocks continued to tighten, but core machine orders. So they were expected at negative 1.5%, came in at negative 9.8%. Year over year was expected at 4.3%, came in at 4.3%. So 14.3 was expected, came in at 4.3. A full 10 basis point, a full 10% miss. And again, this is where we continue to see this slowdown in the Asian theater as well. And this just puts it into perspective of what that drop looks like in comparison to what we've seen in 2020, 2018, and 2019, just to kind of put it into perspective. So again, a lot of problems that remain as issues continue to arise, especially when you look at China. So that's all we have for you today. We will have our frac spread show also today, just because we do have off on Friday. So we wanted to get everything out, make sure everyone's well informed. If you have any questions, you can find me in the comments section or on Twitter. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.